The amount we save as a percentage of our disposable income is known as the savings rate. The Bureau of Economic Analysis has been tracking this since 1959, and from that time until about the mid-1980s, the savings rate averaged about 12%. It's no coincidence that the savings rate decline began in earnest at about the same time as the widespread use of credit cards. Credit cards have been around for decades, but the 1980s brought us cards issued by bank cooperative arrangements, which were marketed as Visa and MasterCard. And since then, the savings rate steadily dropped to a low point of about 2% in 2005. It recovered somewhat in the wake of the financial crisis, but's dropped back and is currently about 3%. Not surprising is the fact that consumer debt moves in the opposite direction as the savings rate and is now at its highest level ever. Why is this important? Consumer spending accounts for over 70% of economic growth. The recent slight uptick in growth that we've seen coincides with an up move in consumer borrowing. The question is, how long will this last? Americans seem to be addicted to credit and may only stop borrowing when they're forced to. Credit card companies make a great deal of money from borrowers, so it's unlikely that they'll end the party. The most likely end of the binge will come from higher costs to carry the debt load, and that will come in the form of higher interest rates. We're watching this carefully. Stay tuned. I'm Tim Gardner, and this has been your Money Minute.